Hello, Business 330 students. This is Professor Hassey starting our week number 4 introduction video for this week of February 23rd to March 1st. The week is entitled Capital Valuation. We're going to be looking at bonds and stocks in our class on Wednesday evening. I'm speaking to you live and in color from my office at the University of Laverne campus in beautiful Laverne, California. Today, we're going to just make sure that you understand that you have case number 2 set up and be ready for posting this evening, Tuesday. Case number 2 is due. Also, I have posted the grades to case number 1, and I'm going to walk through that, not case, assignment or quiz number 1, and walk through that assignment in just a minute. So we're talking about stocks and bonds this week. If you go to your Blackboard, bring that up here. You will see in the assignments section, the solutions for assignment number 1 have been now posted to Blackboard, and you can see those solutions for your work. And you can go to your grade center and see your grades and individual work being returned to you for the assignment number 1. So those grades are now available. And let's bring up what assignment 1 looked like. Okay, here's assignment number 1. Remember, this is just a small portion of your grades for the overall session, so don't anybody get in a panic, but we all did pretty well on that. The solutions are posted again to the assignment 1 file folder in Blackboard. The number of points given to each problem is given on the assignment. And I'm just going to walk through a couple of the areas where some of us missed, but mostly we did a very good job. So assignment number 1, what are the goals of financial management? Well, the goal is maximize corporate value. That's as simple as put as possible. Maximize shareholder value for the company. What are the functions of the financial markets? Basically, to transport risk, provide liquidity, diversification, a way to buy and sell a variety of financial securities in the marketplace. The 2 major decisions made by a financial manager are investment, what asset to invest in, and the financing decision. How are you going to finance the investment in that asset? I think the multiple choice problems are pretty well self-explanatory, and everybody pretty well got those right anyways. The only big problem is on question 6. Select the best answer. Which of the following information is not provided by the financial markets? Microsoft earnings are not provided by the financial markets. They're provided to the financial markets by Microsoft. So that's kind of a little difficult little question to answer there. But Microsoft is the only one that provides to the financial markets. All the others, gold, cost of borrowing, and the wiring fees are all market generated by the financial markets. Here's one that drove a lot of people nuts. It's determined 3 numbers. Determine the earnings before interest and taxes, determine the net income, and determine the cash flow from operations. And you're given a whole series of financial terms, and you are asked to put them in a financial statement format to come up with this information. I'm assessing your ability to understand key points of the income statement, the balance sheet, and the statement of cash flows. So as you can see, there's a couple of $500,000 sales. That's that's on the income statement. $10,000 cash dividends. That goes nowhere. That has nothing to do with the income statement and nothing to do with cash flow from operations. Cash dividend is cash flow from financing. $300,000 cost of goods sold expense, $20,000 administrative expense, $20,000 depreciation expense, $40,000 interest expense after earnings before interest and taxes, $10,000 purchase of productive equipment. That's the purchase of an asset. It's not an expense. That's cash flow from investing. Has nothing to do with this problem. No changes in working capital and a tax rate of 35%. So as you can see, I put this together. Sales minus the expenses of cost of goods sold, administrative expense, and depreciation expense give you a earnings before interest and taxes of $160,000. Answer number one. You subtract $40,000 interest expense from that and determine the income tax of $120,000 times 35%. $120,000 is earnings before interest and taxes minus interest, and I get $42,000. Thus, I now get a net income of $78,000. Remember, cash flow from operations is net income plus depreciation plus or minus working capital. Well, net income is $78,000. Depreciation is $20,000, and there's no changes in working capital. So answer number three, cash flow from operations is $98,000. Good job. The last few problems are mainly your interpretation of the standard measure of a firm. This is taken right out of chapter 4. Those definitions. Question number 9, I'm asking you to define to me a profit and loss or income statement. What does it tell you about a firm, who uses it, and why it is important? All three of those questions needed to be answered. Question 10 is to pick one company from your portfolio and find the earnings per share for the last 3 fiscal years. And how have they changed? Have they gone up? Have they gone down? What has happened to the earnings per share of your company over the last 3 years? 3 fiscal years. And then question number 11, that same company, go back 2 fiscal years and determine the current ratio, which is current assets divided by current liability, the debt ratio, total liabilities as a percent of total assets, profit margin, net income divided by sales of the company, and return on total assets, net income divided by the assets of the company. A brief comment on what they tell you about the company for 2 fiscal years for your portfolio company. And that's what I was looking for in assignment number 1, a brief definition of the meaning of what finance is all about, and some financial statement and financial analytical equations to determine. The grade, if you go to your grade center, is located in Blackboard, and you can see your grade. And if you had some changes or if I took some points off, I returned your folder back to you, and you can download it and review it. If you got 100, I didn't return your paper back to you because you did perfect. So there's where we stand. Again, assignment number 2 this week, due tonight. And that'll lead us up to next week's work, which will be distributed on Wednesday, the midterm examination, which combines assignment 1 and 2 together into a midterm format work. Now let's take a look at the definitions of this week's topics, bonds and stocks.
Company can raise capital. It can do it by borrowing money, which is debt, or by selling shares of itself, or essentially allowing other people to become partial owners of it, and that is equity. And these directly translate into securities that you're probably familiar with, but maybe you didn't have a more exact idea of what they are. You know what equity securities are. And just so you know, what is a security? A security is essentially something that can be bought and sold that has some type of claim on something or some type of economic value. So a security in the equity world is a stock, and a security in the debt world is a bond. Let me explain this. Let me just draw the balance sheet for a for the fictional company. It was pointed out to me that socks.com actually is not a fictional company, that someone is indeed selling socks online. So, which I, by the way, think is a great idea. So let's see. I have my assets right here. These are the assets of the company, but that's not what we're worried about right now. Assets, and let me draw the equity of the company. Right, this is maybe shares that they sold, and so let's say that they have, I don't know, that there are 10 million shares. 10 million shares. And then we have the debt. The debt of the company, or the liabilities. There are other liabilities other than debt per se, but that's all we'll worry about right now. This is the debt. I'll do it in brown. We have the debt. The debt. And maybe the assets. Let me just think of a good round number. The assets are $10 million in assets. And let's say our debt is, I don't know, $6 million. And then what's left over for the equity, right? And the way you have to view it is, okay, if I have $10 million and I owe people $6 million, what's left for the owners of the company? Well, the owners of the company will have $4 million left. $4 million left. And it'll be split amongst the owners of the company. And there's 10 million individual shares. So if every person who has one of those stock certificates will own 1/10 millionth of this $4 million, or essentially, what is it, 40 cents a share or something. So anyway, this is, and I think you're familiar with this already, this is essentially stock. Right? When we say 10 million shares, that's 10 million shares of stock. I could just draw I could draw 10 million stock certificates. And I guess whatever the ticker symbol is. And there could be 10 million of those. Now, debt is interesting. There's a lot of ways you can raise debt. And actually, there's a lot of ways you could raise equity. It actually doesn't have to be with selling. Well, for the most part, you are selling stock. You could maybe think of some other way. And we'll talk about other forms of equity, preferred stock, and all of that. But in the simplest level, you're really always selling stock. Debt's a little different. Debt could be just in the form of a bank loan. So, this could be a bank loan, where you literally go to the bank and say, hey, I need $6 million. And they say, okay, here you go, and we'll give it to you for this interest. And you have to pay back the money above and beyond the interest over this time schedule. So, not too different than maybe a mortgage. Or they might say, okay, you pay the interest for 5 years. And at the end of the 5 years, you also have to pay the principal amount. So you have to pay the whole $6 million. So you maybe have to come up with a new loan or something like that. So that would just be a bank loan. There's other things that are revolving lines of credit, which is kind of like a company's, I guess a company's credit card to some degree, that it doesn't have to use it, but if it does, that's kind of debt the company takes on. But kind of the one that people always talk about, I guess in the same phrase, is bonds. So bonds are essentially, you are borrowing from the public markets again. You're borrowing from a bunch of people. So what you do is you have these 6 million, let's say the $6 million, and it could be divided into, let me think of a good now. You could divide this into 6,000 bond certificates, right? So this could be 6,000 bond certificates. Let's see, and 6 million divided 6,000, right? That's 1,000, right? So it could be 6,000 times $1,000 bond certificates. Bond certificates. And let's visualize what a bond certificate could look like. So that could be a bond certificate, and its face value, and sometimes they'll call it the par value or the stated value. It'll say, let's call it bond from company XYZ, and its face value is $1,000. So it's essentially, this is an IOU from company XYZ. If I were to hold one of these, if Sal had one of these sitting on my desk right now, that tells me that company XYZ is going to pay me $1,000 at some future date, right? And that future date is at maturity. So it's going to pay $1,000 at maturity. And you say, oh, well, Sal, that's all good, but what about the interest in between? And there's two ways to think about this. Maybe they're going to pay me $1,000 in the future, but I only have to give them $500, right? So if you think about it, there's automatically interest accruing in that, right? If I gave them $500 and then 5 years later they pay me $1,000, they're essentially paying interest, right? They're paying me more back than I gave to them. And in future videos, we'll actually do the math of how to figure out that type of interest. And in that situation where they're not kind of paying me interest as they go, this would be viewed as a zero coupon bond. And I know I'm throwing out a lot of terminology, but it'll all make sense to you in a second. So zero coupon essentially means they're not paying interest until they pay off the whole loan. And then they might the interest will be implicit in the whole value of the amount. And I kind of jumped the gun a little bit, but coupon is essentially a regular payment on the bond that the company makes, in this case XYZ will make. That is essentially, you can almost view it as a kind of interest. But if you really had to figure out the interest that you're getting on the bond, you would actually have to figure, and I'll do maybe a whole playlist on bond mathematics. You would have to figure out, it's based on the coupon, what you gave them, and then what they're going to pay you and when they're going to do it. So it's a little bit more complicated than just saying, oh, look at that, they're giving a 6% coupon, which essentially means, twice a year they're going to give me 3% of the value of my bond. So just a big picture, both of these things are traded. This is a stock, it's traded on exchange, and you're probably familiar with that. If you go to Yahoo Finance, you type in the ticker symbol and you get the price for that day. Bonds are also traded. Unfortunately, it's not as easy to get a quote on a bond. Usually you have to have a Bloomberg terminal of some type. You can't get it on Yahoo Finance, and I think that's by design by bond traders because they probably don't like the transparency there. But it is just like a stock. It is a security. It is traded. There is a price. But then there's a very fundamental difference in what kind of the holder of the bond is doing. In a bond, you've essentially, if I'm holding a $1,000 bond, that means that I've lent some amount of money to the company, and it'll be in this part of it. And as long as the company doesn't go bankrupt, they'll pay me some interest and pay me my money back. When I own a stock in the company, right, I own a share of the equity as opposed to a share of the debt, which was the case with the bond. When I own a share of the equity, the company's not promising to pay back anything. It's just saying, look, you are a part owner of this company, and anything that any of the owners get, you'll get. So if this company becomes worth a lot, if we start dividending out things to the shareholders, then you'll get that. If the company gets sold by someone and pays X dollars per share for it, you'll get that money. And if the company goes bankrupt, you'll also go bankrupt. And that actually leads to an interesting question. If the company goes bankrupt, and let's say, actually, let's do the example right now. Let's say the company goes bankrupt, right? And I'll do a more in-depth example of this. The question is, let's say the company goes bankrupt and people decide that it's not operational anymore, that it just can't do business. Because there's actually two types of bankruptcy. There's one where you say, oh, the business is good, and it just can't pay off its debts, so we have to somehow restructure this side of it. And then the other type of bankruptcy is liquidation, where they say, you know what, this business doesn't even make sense to operate anymore. Let's just sell off all of the assets. So the question that I'll leave you with in this video is, what happens in a situation where you enter bankruptcy? People want to liquidate the assets, and let's say when you liquidate the assets, there's only $8 million of assets. So the question is, who do you think is going to eat that $2 million? Is it going to be the debt holders or the stockholders? Who is going to lose their money first? Or you can almost say, who is more senior when it comes to actually getting their money back? And I'll leave you with that maybe to the next video or a future video that I'll do on bankruptcy. See you in the next video.
Okay, there's a somewhat confusing, but not too confusing definition of stocks and bonds, and that's our topic that we'll talk about in class on Wednesday evening at 6 o'clock. Again, assignment number 1 has been posted to Blackboard. The solutions are there for your review. If you have any questions on that, please stick around after class on Wednesday. I'll be happy to answer any questions for you. Assignment number 2 is due this evening. Thanks, everybody. We'll see you in class Wednesday evening. Adios.